Today on Retire with Purpose, a retiree shares with you keys to a successful retirement. We share a hierarchy of financial wellness, and we answer the question, are you overpaying your financial advisor?
Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weade is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
Great to see you again. I'm Lee Kelso here with Casey Weade, certified financial planner. He is the president at Howard Bailey Financial, also a host of the Retire with Purpose podcast, one of the top 50 financial podcasts on iTunes. And it's because of that popularity that he gets such great guests, like the guy you're going to hear from today, Fritz Gilbert.
That's right, Fritz Gilbert. This is quickly becoming one of our most downloaded podcasts of all time. And I think it's because his personal experience, not just his fame in the blogging world, he has one of the best, it's been awarded as one of the best retirement blogs ever. It's an award-winning retirement blog called the Retirement Manifesto. And it is great, but the reason it's great is because his experience is chronicled when it comes to retirement. He started the blog to get to understand what it was going to be like and really do a good job in planning his retirement. So he started it prior to his retirement date, and he's continued to do it in the coming years. So if you're 5 years out from retirement, you have the opportunity to go check out his blog and see what your experience might be like and learn from some of his mistakes and some of the things that he's done right as well. He took this blog, he turned it into a book, Keys to a Successful Retirement, which we're going to be giving away here in just a little bit if you stick around. We're going to kick off by sharing one of the segments of the interview that we did there with Fritz, and this is where he shared with us exactly what the biggest key was for him to having this successful transition into retirement, and it had a lot to do with time.
But what I found was those people that spend the most amount of time thinking about retirement, what they want their life to be, not just the financial stuff. You know, what do you want to do with your time when after you retire? What interests you? What do you want to pursue? Those types of things and the amount of time that you spend thinking about them, to me, is the biggest thing I've learned, because having been through it myself and spending that much time, my transition to retirement, Casey, was absolutely flawless. It was smooth. It was absolutely enjoyable. And I'm 2.5 years in now, and I still absolutely love every day of retirement. I've not gone through any boredom. I've not gone through any depression. I've not gone through any, loss of identity. A lot of those things that people hit.
This is why when you come in and visit with our team, the first thing we're going to say is that we're not going to take you on as a client today. We're not going to make any specific recommendations or start putting together a plan today for you, because it took you a lifetime to get to where you're at today. And it doesn't do you justice to just make snap decisions when it comes to your finances, when it comes to retirement. You should take your time in these decisions. The more time that we find we spend with the families that we work with, the better transition they have, not just on the financial aspects of retirement, but the non-financial aspects more importantly. And what Fritz often talks about and helps people build is what he calls a no regrets retirement plan. And as he said there, it has a lot to do with the amount of time that you spend in this process of preparing for retirement. The question then becomes, well, how much time do you spend on the non-financial versus the financial aspects of retirement, and when?
Clearly, you've got to have the financials. So if you were going to have only one of the two, clearly you've got to have the financials, right? I just wrote an article last week, the 6 most common mistakes that people make for retirement. And like 43% of retirees have regrets. And the vast majority of those are around how much income they've got in retirement. They were overly optimistic on how much Social Security they were going to get. They were, overly optimistic on their returns, whatever. They didn't get the financials right, and they're now having regrets in retirement. So you've got to have the financials right. And for the first, up until maybe you're 2 years away from retirement, I'd say, maybe even a year and a half, I would say make the focus the financials. But if you're within 12 months of retirement and you haven't started thinking about the softer stuff, as I call it, man, red light, think about it, because it really, really matters.
Maybe you have a bucket list for retirement, like a lot of individuals have. You have this list of things that you really look forward to accomplishing in retirement. Well, Fritz has a different spin on how he manages his bucket list and how he recommends you do as well.
What I try to do on my bucket list, instead of just focus on travel, I write in my book that life is like a wheel. And your wheel has spokes, right? So you've got your spiritual aspects to your life, your relationship aspects, your financial aspects, your whatever, right? There's multiple areas in your life, and try to create bucket list items for each one of those. And I would say on every one of those different spokes, the goal being obviously you develop all your spokes equally, because a wheel rolls best when it's round, and it's only round if all your spokes are the same length. So try to come up with bucket list items on all those different aspects in your life. And I would say every one of those aspects of my life have bucket list items that I still have in mind that I would like to do.
That was one of my biggest takeaways from his book, Keys to a Successful Retirement, where he discussed not just looking at all those different aspects of your life, but looking at your values. Where are your values? Is it physical fitness? Is it family? Is it travel? What are those values that you have for yourself? And then building that bucket list around them. And then going back and checking in on those things from time to time. Because again, you think of this as a wheel. If one of those areas that you truly value in life, in retirement, isn't full, then you have a lopsided wheel, a wheel that doesn't run real smoothly. How can you start creating that bucket list that can be well balanced, not just for you, but also your spouse and your marriage as a whole? Well, Fritz has an idea here that he calls the activity jar.
We came up with the concept. We put a cookie jar in our bedroom with a little Post-it thing next to it. And we kind of encouraged each other, hey, once a week, come up with an activity that you'd like to do. It can be something we've done before, but ideally maybe something we haven't done before, right? So it was neat, because I didn't know what she was putting in the jar. She didn't know what I was putting in the jar. But each week we would each put an activity in the jar. The thinking being, on the day we retired, if we did one activity a week, we would have 2 years worth of activities to do, right? Once a week, half of which were driven by me, half of which were driven by her, right? So it's a neat concept for either one in the relationship to have equal influence on what you're going to be doing in retirement.
That's a really cool idea. I like that idea of an activity jar.
I know. I brought that idea home to my wife. Every time I do a recording and I have one of these interesting conversations, usually I'm looking for one of those nuggets. I'm just looking for 1 or 2 nuggets that I can come back and implement in my life that can make an impact, that can just take things that much further, just make our life experience that much better. Well, I take so many of those home that we didn't get real far with the activity jar, but I'm still pushing. I think we're going to get this one done. I'd love if you do it for 52 weeks. Each of you do that, you've got 104 activities. You can compare those and design a good chunk of your retirement experience around that.
Yeah, and if you don't like the one you drew out for that week, put it back and draw the next one. You're not tied to it, right? You're retired. It's up to you. It's your choice. I like that idea. That's a lot of fun. And if you'd like to hear more from Fritz Gilbert, this is a great opportunity for you, because Casey has put together an opportunity with Fritz to get you a copy of his latest book. It's called Keys to Successful Retirement, Staying Happy, Active, and Productive in Your Retired Years, and it's free to you right now. It's an in-depth guide to retired living to turn your newfound freedom into years of fulfillment. And also you can get a stack of ideas. All you have to do is call the number on your screen, 482-9559, or text KEYS to 482-9559, 866-482-9559 to get a copy of Fritz's new book. Sure hope you will. All right, so coming up next, Marshal Johnson joins Casey to take a look at how you can measure the wellness of your retirement, looking beyond investable assets.
Do you have an IRA or 401k? You think of this as your money, but it's really a shared account with the IRS, and it all boils down to taxes. You've been contributing to your retirement accounts for years, but eventually, Uncle Sam will want his cut. Having a strategy in place for how and when you'll withdraw that hard-earned money could have a huge impact on how much you pay in taxes versus how much you keep. Safeguard your lifelong savings now with a complimentary tax guide by going to retirewithpurpose.com/taxes. That's retirewithpurpose.com/taxes.
Hey there, and welcome back. We are now joined by my good friend and co-host of the Retire with Purpose podcast, Marshal Johnson, is here with me. Yeah. And this is our opportunity to go back to one of those weekend reading articles that we sent out at one of these last Fridays. If you're not sure what we're referring to, then you need to get yourself signed up for weekend reading for retirees and pre-retirees. You can do that at retirewithpurpose.com. If you're signed up, then you will receive one email every single Friday with trending articles in the financial planning space, all designed to keep you on top of those trends so that you can make better decisions about your financial future. We like to select one of those articles and spotlight that right here with you, as well as the podcast. If you'd like to hear the full-length conversation with Marshall and I on this particular article, check out the episode number 187 at retirewithpurpose.com. This article comes to us from the Financial Planning Association, and it is titled Introducing a Hierarchy of Financial Wellness.
Financial wellness. Well, one, I love this article because it's from the Financial Planning Association. They always do a really great job with really in-depth articles, but if you've heard that term lately, it's no surprise. A lot of financial firms are throwing around the term financial wellness, and a lot of us kind of listen and go, what does that really mean? Is that just marketing jargon, or is this a concept I need to be aware of?
I think this is the future of financial planning, and this is what you're seeing from organizations like the Financial Planning Association, where they've designed this article to teach people like us, to teach your financial advisors, your financial planners. And that's why we like to provide you with these types of educational articles, because you're not getting that marketing jargon. You're getting something of real value. The future of financial planning is not just looking at your financial life in a vacuum, but looking at it on a holistic basis. You know, we're taking into consideration your physical health, your mental health, your behavioral health, as well as your financial health. And this is a lot like our financial planning process.
Yeah, in this article, it kind of relates it back to, if you've studied psychology, Maslow's hierarchy of needs, right? We've got these basic tenets and things that we need for stability and security, and it really does that. It relates that to our financial situation, and it starts with organizational wellness. Get organized.
Yeah. This is a huge one, and one that many individuals struggle with. If you're struggling with getting your finances organized, it's okay. That's what we do. We're really good at it as well. We have seen individuals come in throughout the years bringing in bags full of statements, boxes full of statements, and saying, hey, I don't know how much I'm spending. Hey, I don't know where all my money is. Can you help me get organized? And that's what we are really good at. We'll help get you organized. So first and foremost, you know what you have. You know what where you stand. And if you're not organized, how can you ever proceed to that next step? If you don't know how much you're actually spending, how can we structure an income strategy to ensure that you're never going to run out of money in retirement? We can't. We need to know where you're at today before we start talking about where you're going in the future.
Absolutely. Understanding that physical wellness comes next, right? You know, if COVID illustrated anything to us, it's that financial wellness cannot be separated from your behavioral or your overall health.
Yeah, 2/3 of bankruptcies in the United States are medically related.
Wow.
And this is why this is such an important factor when it comes to your financial health. We need to make sure that you have the right coverages in place when it comes to those potential physical ailments you may face throughout your retired years. We want to make sure you're taking good care of yourself as well. If we take good care of ourselves, that should control our medical costs. And number 3 is the cognitive wellness.
Cognitive wellness, right? We talk about mental health as we age, and we deal with a lot of families over time who suffer from decision-making abilities and some of the things that come up with memory loss and some of the diseases that we see older individuals face. And this is really important when it comes to financial decisions.
Yeah, and the article actually started with this being the biggest issue facing retirees or future retirees, that being your cognitive health. They say in the beginning of this article that it's not a big stock market crash that is the biggest risk to your financial health as you age. It has to do with diminished decision-making capacity and just being taken advantage of because of that diminished decision-making capacity that may come along with age. And Harvard did a study as well showing that peak financial decision-making happens at age 53. At age 53, that is the peak of our financial decision-making capacity. So when we get to those ages, and you know, my dad was in in this business of working with individuals and their families for almost 40 years. And I knew a lot of those individuals when I was a kid. We're still working with those same people today, but now we're bringing in their children. And it would have been a lot easier if we could have had those individuals on board with getting those children on the same page as them early, so that we could have had a round table. So there always would have been that trusted third party that we could lean on.
Next up, we've got behavioral wellness. I think this is one that's really near and dear to my heart. Understanding that when we talk about money, it's not just about money. Money can represent love, fear, anxiety, security, and understanding that our emotions can be swayed in that decision-making process.
Yeah, and I think this is what we're really good at when it comes to gauging where you're at and what that plan should be designed like because of who you are as an individual. This is going to be one of the major struggles of advisory firms that are a little behind the buck here. Those individuals, those firms that have been doing financial planning based on just gathering the facts. If we just gather the facts, we could leave a lot out there that could result in behavioral or psychological mistakes down the road. One of those big ones would be an income strategy. You might think you're just going to take that 401k, roll it over to an IRA, and take out 4% every year, and everything's going to be okay. But what happens when the market's down 30% in 30 days? Then are you going to panic? And most likely you're going to panic because everything's in one place and it feels like everything's going down all at once, even though it might not be. So instead, we want to design an income strategy to guard against that. And in many instances, this is buying you time. So we're going to take that portfolio and split it up. We're going to have that first leg of income, guarantee your income needs for 5 years, 10 years, 15 years, whatever's appropriate for you and your risk tolerance. Then we're going to take risk with that second leg, more risk with that third leg, so that you can better manage those downturns in the market psychologically.
Yeah, it's the biggest mistakes that I've seen in this business have been folks that have made emotional decisions and allowed the emotions to creep in and allow difficult decisions. And sometimes even the most well-educated individuals make poor decisions when times are tough. So understanding that and building that into the plan, I think, is key.
And as you can see on your screen, when it comes to this hierarchy, it looks a lot like Maslow's hierarchy. And what's at the top of Maslow's hierarchy? That's self-actualization. And to us, right here, it's holistic wellness. And our firm, that's meaning. Right. If we do a good job of getting organized and following these steps one at a time, physical health, our behavioral well-being, our cognitive well-being, et cetera, if we do a good job of getting organized and putting together a good plan that's fitted and customized to you, then we can take things to that next level in your life and create even more meaning.
Absolutely, and it all comes together in that end.
Yeah, and if that's where you're at today, maybe you're just trying to get organized, maybe you're ready to put together a true income strategy that can last the rest of your life and give you the confidence to spend and live life like you would like to live it, then give us a call right now or text CONSULT to the number on your screen, and we'll schedule a complimentary consultation with a member of our team. It could last no more than a half an hour. It could be done over the phone, could be done over Zoom, it could be done face-to-face in one of our local offices. Just call or text the number on your screen. Stick around. If you're questioning whether you're paying your advisor too much, we're going to answer that question and show you how you can figure out exactly what you're paying on your own.
Do you have an IRA or 401k? You think of this as your money, but it's really a shared account with the IRS, and it all boils down to taxes. You've been contributing to your retirement accounts for years, but eventually, Uncle Sam will want his cut. Having a strategy in place for how and when you'll withdraw that hard-earned money could have a huge impact on how much you pay in taxes versus how much you keep. Safeguard your lifelong savings now with a complimentary tax guide by going to retirewithpurpose.com/taxes. That's retirewithpurpose.com/taxes.
It is time for Casey to answer some of your questions, and if you have a question, it's real easy. Just email info@howardbailey.com. We might use your question here on the air, and if we don't, you'll at least get a reply from the Howard Bailey team. Our first question today is there a way to find out if the fees my financial advisor is charging me are fair? How can I be sure I'm not paying too much?
Well, the first step is figuring out how much you're paying. Let's assume that you've already gotten to that point where you know what your advisory fees are. And let's assume you're working with a fee-only or fee-based advisor like ourselves, where you're paying a percentage of assets under management. So an advisor is managing your investments and charging you a fee every year to manage those dollars. If you're in one of the articles we will often use of the families that work with us is we'll go back to one of our favorite bloggers, finance bloggers and financial and retirement researchers out there. That's Michael Kitz's, which you'll also find in a lot of our weekend reading articles that we send out every single Friday, because he does some amazing research. He conducted a study that showed what the average advisory fee is for families at different wealth numbers. So do you have $250,000 to $500,000 under management, $500,000 to $1 million, $1 million to $5 million, $5 million plus? Depending on how much you have invested, that will determine what your advisory fee is typically. The more you have, the lower those fees typically get. And on that $500,000 to $1 million range, the research shows that the average advisory fee is 1%. That's 1% to manage those assets. But he goes on to explain that that's not where it typically ends. He illustrates what the average all-in costs are of working with a financial advisor. And this is what we find quite often individuals just aren't aware of. They're not aware of those other hands that are in the cookie jar, so to speak. Those could be internal expenses inside of mutual funds or ETFs, could be financial planning fees, and it could be trading costs or brokerage fees, account opening fees. Once all of those different fees are included, that same individual that has $500,000 to $1 million that's being charged 1%, their average all-in cost is 1.65% per year. That's significantly higher, right? We're talking about a significantly higher fee than what you might have been illustrated or told by your financial advisor. If you're trying to figure this out for yourself, one, figure out what that advisory fee is. Is it 1%, 1.5%, 2%, 0.5%? Figure out what that fee is, and then look at your holdings. If you own individual stocks, you won't have to worry about internal expenses. If you own ETFs or specifically mutual funds, then you're going to have more expense. If you own variable annuities, you have even more expenses on top of that. And one of the tools we like to use is called Personal Fund. You can go on over yourself, go to personalfund.com. It's one of the neatest tools out there, I think, for investors and do-it-yourselfers. You can plug in the mutual fund that you find in your portfolio, and it'll share with you not just what the illustrated costs are, but some of those hidden expenses inside the mutual fund, and show you better, lower cost options. And quite often what you might find is the fund that you're using, it's not the lowest cost fund. It might have been a proprietary fund, or it might have been a fund that that firm has revenue sharing agreements with, where they're getting extra compensation for having that fund in the portfolio. You're not getting the best deal, but you're able to add up all of your costs that way. Now, I don't want to spend too much time on costs though, because you didn't buy that new BMW, you didn't buy that new Honda for that matter for the price, right? Otherwise, you would have went out and you would have picked up the cheapest car you could have possibly purchased. You were looking for value. It could have been gas mileage, it could have been luxury, but you were looking for value. We work with families that are cost conscious but value focused. We recently had a gal that came to us from Boston that had $10 million invested. This is someone that should be paying a very low advisory fee, paying 0.65% per year. After we looked inside though, she was paying over 1% per year. And when it comes to the value, her portfolio, if you charted the performance against the S&P 500, it tracked it. It basically did exactly what the index did. She had all U.S. stocks, no international equities. She could have just went out and bought an index fund and saved herself any cost, that 1% per year. She could have reduced her cost nearly to zero and just tracked the index, because the advisor wasn't adding any value, especially from a tax perspective. We showed how we could give her a tax alpha of over an average of 1% per year, 1.04% per year, with a specific strategy specific to her to minimize the tax impact of that investing year over year. That's real value.
It's not what you pay, it's what you get, right?
That's right.
Exactly.
And if you want that analysis, just give us a call. We'll run through a total cost analysis and a tax analysis for you for no cost.
All right, let's move on to question number 2. If I'm planning on retiring in the next 5 years, Should I focus on getting out of the stock market now and looking at more conservative options?
Well, I can't say because it really does depend. And that word is, unfortunately, it depends, comes up a lot in the financial world because it really does. And it depends on three things, something called CAN. We use this acronym. Do you have the capacity for the risk? Do you have the attitude for the risk? Do you have the need for the risk? So if we break that down, do you have the capacity? Can you afford to take the risk? Can you afford to take losses at this time in your life? Do you have the attitude for the risk? If you end up seeing your portfolio down by $100,000, 20%, if you see those losses, will you panic? Will it cause anxiety in your life? Do you have the need for the risk? Maybe you don't need to take the risk in the first place. So we want to look at all three of those different aspects of risk and determine that specific to your unique situation.
Okay, so Terry wrote in to ask the Howard Bailey team, how do you get in the it's okay to spend your money mode in retirement? That's a great question.
Well, that can be a really tough one, Terry. You know, we've spent our entire lives many times just saving and accumulating, pinching our pennies, getting to a point where we could retire, and now we need to turn on the spigot. Now we need to start spending because the goal of saving all those dollars probably wasn't just to have a scorecard or pass on a bunch of money to someone else when you passed away. Maybe that is your goal, and if that is, fantastic, good for you, but for most of the families we work with, it's dollars that have been saved so they can enjoy a retirement, enjoy financial freedom down the road, and usually that comes down to spending. But if you don't have a real plan, that's where you need to start. You need to put together a plan so that you know you can spend the dollars and they're going to come in next month. You can spend dollars this month, they're going to come in next month. You know that income will be there forever. Once you put that plan together, you need to automate it. You need to get a paycheck every single month, just like you did during your working life, and start living a bigger life, spending those dollars you've worked so hard for.
Yeah, what you call mailbox money, right? You just know it's going to be in the mailbox. Right. Yeah. Well, we hope that you'll take advantage of this offer because it's sincerely offered, and that is an opportunity to sit down with a member of the Howard Bailey team to take a look at how well provisioned you are to cope with all the pitfalls that can come your way in retirement. A stock market crash, a health crisis, gosh, runaway inflation, who knows? There are many things that can derail your retirement. So why not take half an hour or so and figure out how well prepared are you for all of those? It's so easy to do. Just call 866-482-9559, and the next callers have an opportunity, the next 10 callers have an opportunity to sit down with a member of the Howard Bailey team, even on the phone or Zoom if you prefer not to meet in person. It's easy to do. So be one of the next 10 callers at 866-482-9559 or text CONSULT to 866-482-9559 and reserve your space with a member of the Howard Bailey team and get yourself on the road to a retirement that gives you real purpose. We are back next week. We'll see you then.